In this video, I will discuss our paper, The Impact of Basel III Liquidity Regulations on U.S. Bank Performance in Different Conditional Probability Spectrums. I am Sathiavanee Veeramoothoo, and this is joint work with Shawkat Hammoudeh. The 2007-2009 global financial crisis demonstrated how the economy can quickly go into a severe recession when banks face difficult challenges and households lose confidence in the banking sector. For example, we know that the insolvency of Bear Stearns in March 2008 was what triggered the 2007-2009 Great Recession, and we know that the growth rate of the US economy plummeted by 8.4% in 2009. The Basel Committee on Bank Supervision was founded in 1974, and they produced the Basel III Accords as a response to the global financial crisis of the year 2000. And they later included important new measures following the crisis of 2007-2009. Specifically, Basel III introduces a liquidity framework by introducing the two liquidity constraints, namely the liquidity coverage ratio, the LCR, and the net stable funding ratio, the NSFR. So these were introduced with the aim to reduce liquidity risk and maturity transformation. The LCR addresses liquidity risk and relates to banks' ability to survive 1 month of stressed funding conditions. Now, it's important to think about the trade-off that banks face. On the one hand, they can choose to have a higher level of leverage, which increases their profitability, but at the same time, holding more leverage increases their liquidity risk. So banks are constantly trying to balance these two things, and the Basel III Accords aims to help them and guide them when they make those decisions. The NSFR addresses funding risk and relates to banks' risk profiles based on short-term funding mismatches and the long-term funding of assets. In this paper, we want to document the performance of US commercial banks before and after the implementation of the Basel III regulations. We also want to document the impact of those regulations on banks' performance by using the two liquidity ratios that I mentioned, the LCR and the NSFR. And finally, we want to document the impact of the Basel III regulations on the profitability of big banks and small banks separately. This is the first paper, as far as we know, that studies the Basel III liquidity constraints on bank profitability using the simultaneous quantile regression approach with time-fixed effects. And we do that using 10 quantiles. So I'm going to talk in a little more details in a couple of slides about why we use this method and what it helps us tease out of the data. So specifically, it allows us to study independent variables and how these affect the conditional distribution of profitability differently based on the specific quantile of the profitability distribution of the banks. So that's one. And secondly, we extend the findings in the literature on the factors that affect bank profitability by extending the range of the data studied to include more recent data, and we include data up to the third quartile of 2017. And I'm also going to talk about why we stop at that point. So finally, we examine the quantile regression approach along with studying small and big banks separately, and we do that to allow us to provide a reason for why some other studies may have found conflicting results when they have studied the impact of Basel III liquidity constraints on bank profitability. So here's a summary of the results. First, we find graphically that bank profitability does not behave noticeably differently after the implementation of the Basel III regulations. Next, we find that there is a positive and significant relationship between both the LCR and FSR and profitability. However, we note that the small magnitudes of the coefficient on these two variables of interest suggest that they have a minor quantitative impact on profitability. So noting that minor impact, then what we do is we go and we test whether the coefficients for banks with the lowest profitability, so those in the 10th quartile, we see whether there is a significant difference between those banks and banks that are in the very high profitability category, so banks in the 90th quintile. When we do this, we find that, yes, there are major differences. And so we then go and study big and small banks separately. And when we do that, we find that a 1 unit increase in LCR leads to a decrease in profitability for small banks with medium profitability, but it contributes to an increase in profitability for big banks with median profitability. The coefficient on the NSFR is also significant and positive for all the quantiles for small banks, but is significant for all except the 20th through 40th quantiles for profitability when it comes to big banks. The literature that relates more closely to the Basel III requirements and bank profitability started with studies on liquidity and profitability. Hawley et al. In 2010 find that complying with the Basel III requirements has a negative impact on the profitability of European banks. Using a sample of 62 large and complex financial institutions, Octorobi and Pazar-Bazioglu in 2010 find that the Basel III guidelines will lead to higher funding costs and thus lower profitability. Dietrich et al. In 2014 find that the NSFR does not have a significant effect on bank profitability. They used specifically a sample of 921 Western European banks from 1996 through 2010, and they find that about 60% of those banks have not fulfilled the NSFR minimum requirements. And more recently, in 2018, Mashamba finds that the overall benefit of Basel III requirements is positive, as the risk of bankruptcy is lower when banks hold more liquid assets. In this paper, we use quarterly bank level data of US commercial banks. Basel III was implemented in 2013, so we choose 2010 as a start date to have 3 years of data prior to the implementation, and we use the third quarter of 2017 to have at least 3 years of data after the implementation. Now, this data is sourced mostly from call reports. There are 737 financial institutions from the first quarter of 2010 through the third quarter of 2017. And that gives us 22,847 bank quarterly observations. We follow the convention in the banking literature, and one, we drop all banks for which we do not have data on their total assets or in equity. Secondly, we drop all banks which have total assets that are less than $100 million. And third, we drop all banks that experience a growth in the total assets that is amounting to greater than 10% of the total assets in any one quarter. And that is done to account for and exclude mergers. Finally, we eliminate the gaps in the data and obtain data on the 3-month AAA commercial papers interest spread over the 3-month return on the effective federal funds and on the quarterly gross domestic product from the Federal Reserve Bank of St. Louis. This table shows our summary statistics for all the banks in our data. All the variables are standard determinants of bank profitability based on the literature, except for the 2 measures of Basel III liquidity requirements, which are the liquidity coverage ratio, the LCR, and the net stable funding ratio, the NSFR. The variables in this table are given as ratios multiplied by 100, except for economic activity, which is measured as GDP here, which is expressed in thousands of dollars, and size and squared size, which are given as the natural logarithm of total assets and the natural logarithm of total assets to the square, respectively. Basel III requires each bank to have enough high-quality liquid assets that can be expeditiously and easily converted into cash to meet the bank's liquidity needs for a period of 30 days. The LCR captures this requirement, and a value of LCR greater than 100% is expected. The NSFR is meant to assess the medium and long-term funding stability of banks, and it captures how much of the stable funding is available compared to how much of the stable funding a bank is required to hold. Similar to the LCR, a value of NSFR that is greater than 100% is desirable. In addition, the measure of financial structure, which is done in the literature by looking at the ratio of deposits to equity, has a mean and a minimum value above 100. This is also not surprising since banks are known to be highly leveraged firms and their deposits more often than not exceed their shareholders' equity. We proxy bank profitability by using 4 measures. Specifically, we use the return on equity, return on assets, profits before taxes, and the net interest margin. This follows the literature. In this presentation, I will only talk about the return on assets, but the paper contains full results on all these other measures as well. In these 2 figures, we graph the return on assets against the gross domestic product on the left panel and the spread between the AA commercial paper with a maturity of 3 months and the 3 months effective federal funds rate. So that spread captures the measure of risk in the economy. And that spread is given on the right panel. So the measure of profitability here, which is the return on assets, move along with lagged GDP. So you can see that GDP is given by the pink line. And you can see that the measure of profitability given here as the interquartile range of the return on equity in this first panel, and you have the return on assets in the second panel. Here, you can see that there is no clear trend. And similarly, when you look at the return on assets and you look at the interquartile range given by these shaded areas, and then you look at the spread given by this dotted blue line, you can see that, again, there are no clear trends. So just keep in mind, later when we control for the known determinants of bank profitability in the literature, both the relationship between GDP and bank profitability and the relationship between spread and profitability are negative. So I'm going to show these in a table, in a couple of slides. But with these figures, what we're interested with is to see whether there is a big difference before the implementation of the Basel III requirements and after the implementation. And we know that that happened in 2013. So as you can see here, if you focus on the line of best fit on the left panel, you can see that's given by this dotted blue line here. You can see that there is not a big difference before the implementation, so prior to 2013 and after the implementation. If you look at the right panel using the return on assets as profitability, you can see again that there is a little bit of a break here, but this is very close. It doesn't seem like there is a big difference in profitability before and after the implementation. Methodology-wise, we use the heteroscedasticity robust standard errors estimator, the simultaneous quantile regression method, and we add time fixed effects to estimate the effect of the Basel III liquidity requirements on bank profitability. And again, in the paper, we use 4 measures. I'm going to only show you the results for the return on assets here. But the results for the other measures of profitability are qualitatively similar. All quantile regression functions are conditional quantile functions because the quantiles consist of the conditional distribution of the dependent variable expressed as a linear function of the independent variables in a model. This approach is ideal for us to use because of the nature of the problem. Consider, for example, the capital adequacy ratio of a bank. It is possible that the capital adequacy ratio affects the profitability of banks which have a relative profitability in the 50th percentile of the entire banking profitability distribution differently compared to banks which have a relative profitability in the 90th percentile of the entire bank profitability distribution. So we use this method in order to see all of those differences. The quantiles we use range from 0 to 1, and the median quantile, or the quantile of 0.5, is estimated by minimizing the sum of absolute residuals and provides results for the median of the response variable conditional on the values of the explanatory variables. The set of independent variables were chosen with two considerations in mind. One, we wanted to include variables that are known determinants of profitability in order not to overemphasize the importance of the Basel III liquidity constraints. And two, we wanted to adequately capture the effect of the Basel III liquidity constraints. So to fulfill the first consideration, we include the following bank-specific controls. We include capital adequacy, squared capital ratio, credit risk, financial structure, interest expenses, investment in securities, liquidity risk, size, and squared size. But we also need to include some macroeconomic control variables to fulfill our second consideration. So we include GDP, the gross domestic product, and the spread between the return on the 3-month AA commercial paper and the 3-month effective federal funds rate. All of those variables are standard in the literature. The results from this table show a positive and significant relationship between both LCR and profitability and between NSFR and profitability for most specifications. However, the magnitude of the coefficients on LCR and NSFR across all the quantiles of profitability suggests that the LCR and NSFR have a minor quantitative impact on bank profitability. This result is in line with Dietrich et al. 2014 and Giordana and Schumacher 2017, who find that the net stable funding ratio has no tangible impact on profitability. Mashamba in 2018 suggests that one reason for this is that most banks may already keep the amount of liquidity that the Basel III recommends and thus are not impacted by the constraints. Giordana and Schumacher 2017 suggests that the LCR and the NSFR decrease a bank's profits, but also decreases a bank's risk of default. And as such, there is an ambiguous impact on bank profitability. They posit that the impact of LCR and NSFR and bank profitability depends on banks' funding structure instead of the portfolios of banks' assets and liabilities. The constant term for the TAUF quantile regression is the TAUF percentile of the data. So this is how you can read this table. For example, in the median regression entitled 50%, the constant term is the median of the return on equity. A quantile regression coefficient provides the change in a specified quantile of the dependent variable produced by a 1-unit change in the independent variable. So for example, a 1-unit increase in interest expenses decreases the return on equity for banks who have a relative median return on assets, and that's compared to all banks studied by 0.131 units. So this allows us to compare how some quantiles of profitability may be more impacted by certain bank and macroeconomic characteristics than other quartiles. So next we go and we test whether the coefficient for LCR at the 10th percentile is significantly different from the coefficient at the 90th percentile. The coefficient of the NSFR at the 10th quantile is also significantly different from its coefficient counterpart at the 90th quantile. So that kind of shows us that it's very important to study banks who have lower profits compared to banks which have higher profits. And so we study the impact of profitability. So that sort of explains why it's important to study these using the quantile framework, because these variables have a very different impact depending on the profitability of the banks. We also go ahead and study small banks and big banks separately. And we follow the literature and we define the size of a bank as the natural logarithm of its total assets. Now, one of the reasons for why we study big banks and small banks separately is because in 2007, there was this notion that some banks were too big to fail. And in fact, when those banks that were deemed too big to fail actually failed, that led to systemic risk. And that risk actually threatened the stability of the entire financial sector. A recent article by Hagendorf from 2018 explores how a bank's relative size can affect its risks in the higher tails. They explain that this higher risk is not because of the systematic tail risks, sovereign risks, or banking crises, but instead that it is due to bank specific factors that affect large banks disproportionately compared to smaller banks. So here are the results for return on equity for small banks. And then in the next table, we also look at the results for the return on equity for big banks. So comparing these two tables, the coefficient on LCR is positive and significant for all quantiles for big banks, but that's in sharp contrast to the negative coefficient for LCR for small banks for all quantiles. Since LCR focuses on addressing short-term liquidity risk, these results show that big banks are better able to cope with short-term stress compared to small banks. That said, it's important to note that the magnitude of all coefficients on LCR is still small. So all of these numbers are particularly small, and that kind of shows that perhaps these constraints are not affecting profitability at all. Now, bank size could explain why some studies, such as Hawley et al. From 2010, find that higher liquidity constraints negatively impact banks, while others like Mashamba 2018 find that the overall benefit is positive, as the risk of bankruptcy is lower and banks hold more liquid assets. So you can see, although the impact is small, the impact for big banks and small banks is very different. This figure shows that the coefficients of all independent variables for all banks across the different conditional probability spectrums using the return on equity as the dependent variable. So it shows you the graph specifically for all of the variables in the data set. The dashed black line in each plot shows the ordinary least squares coefficients, and the associated two dotted lines show that the confidence intervals show the confidence intervals for the OLS coefficients. The OLS coefficients do not vary by quantile because OLS only estimates the average effect of each independent variable on the dependent variable. The teal line in each plot provides the simultaneous quantile regression, the SQR coefficients, of the independent variables, and the gray shaded area shows the confidence interval for the simultaneous quantile regressions and their coefficients. So the shape of each confidence interval differs across the different quantiles for the SQR coefficients. Now we are interested in comparing the confidence interval for each independent variable under OLS and under SQR. If an SQR coefficient falls within the OLS confidence interval for an independent variable, then that is not a strong case for conducting the quantile regression. If, however, a quantile regression coefficient is not within the OLS confidence interval for an independent variable, then there is a significant difference between the SQR and OLS coefficients. And that would provide a strong case for conducting a quantile regression. And that is exactly what we find here. We find that at least 8 out of 13 independent variables have an SQR coefficient, which does not fall within the OLS confidence interval. Specifically, if you focus on the plot for the liquidity coverage ratio, the LCR, this first one here, we find that the OLS captures the effect of LCR on the return on equity for higher quantiles, and we find that it does not capture the effect for all the lower quantiles. And so for quantiles that are less than 15%, the results that the OLS might give us could be very misleading. We also find that the OLS correctly estimates the effect of the net stable funding ratio, the NSFR, on return on equity only for quantiles that are close to the median, and that the SQR provides the NSFR coefficients for higher and lower quantiles of return on equity that are significantly different from the OLS NSFR coefficients. So this justifies using the approach of simultaneous quantile regressions to conduct this study. So I talked about those when we went over the table. So basically, LCR and NFSR have a minor quantitative impact on bank profitability, and our results for big and small banks suggest that it's important to tailor the policies based on size, and that studying those separately might explain why different studies in the literature might have had different conclusions. The results from this paper are particularly relevant from a policy making perspective because they highlight that liquidity regulations, like I said, one, have to be tailored on bank size, and two, they might also have to be tailored on the relative profitability of each bank. And they can do that while accounting for the trade-off between profitability and the risk of bankruptcy. Both the LCR and NSFR were introduced in Basel III with the goal of improving financial stability so that funding shocks do not substantially increase the probability that any individual bank would be in financial distress. Our results suggest that small banks may be more vulnerable to short-term liquidity risk, while big banks are more susceptible to medium to long-term liquidity risks. Policy should be designed to address these particular weaknesses for subsets of banks based on their profitability and size. Now, in addition, the small magnitude of the coefficients on LCR and NSFR for all the quantiles for all specifications suggests that the Basel III liquidity constraints have a minor impact on bank profitability. This perhaps points to Basel III successfully setting these liquidity requirements adequately, such that bank profitability is not significantly impacted by these requirements, while the entire financial system is less prone to an industry-wide liquidity crisis. Another explanation for the low magnitude of the LCR and NSFR coefficient relates to considering that LCR and NSFR are two of the many factors that can be used for liquidity risk management. Data, for example, in 2016 states that other liquidity risk management factors for banks include a concentration of funding, credit concentration, asset mix, market volatility, and whether banks maintain a liquidity buffer. So it's possible to use all of these other measures of liquidity risk to study the impact of Basel III of these liquidity risks on profitability. Thank you.